the idea is if you borrowed money from the bank to go buy a factory because you were going to, start making stuff, or if you were a company and you issued bonds to raise funds to then go build a factory so you could increase your output next year and sell more product, that's qualitatively different than if you're a household and you charge a flight on your credit card and then go to a hotel resort somewhere and put it all on your credit card just so you can have a fun vacation. So both scenarios involve running up gross debt, but in the first scenario, it's productive debt, that you're doing it in order to increase your future income. Whereas in the second scenario, where it's just funding a vacation, you're increasing your debt in order just to have present consumption. So that's what Lighthizer is saying here, is that what the US has done is basically given claims, his number's 23-ish trillion, my number's 26 trillion-ish over the last few decades, to the rest of the world in exchange for what? That we had a higher standard of living the past few decades than we otherwise would have had.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I'm going to be commenting on some clips from a recent Tucker Carlson episode featuring Bob Lighthizer. I'm not sure if I'm saying his name correctly, who was the U.S. trade representative in the first Trump administration. I think he's kind of been around the block and he's been involved in these sorts of things at least since the late 1990s. Okay. And I think it's interesting. I mean, I had people specifically asking me on social media, hey, Bob, could you comment on this? Because Lighthizer is explaining, hey, where did the economists go wrong? And he's not making it a partisan issue. In fact, he and Tucker agree with each other in the course of the conversation that, oh yeah, it's the Republicans who are worse on this stuff than the Democrats are. Because at least the Democrats are like pro-union and, are skeptical of big corporations and globalism in that sense. And so since what they're talking about here is the loss of U.S. manufacturing jobs and that sort of thing, and then that's the issue. Okay. And so people are asking me to comment on that. Let me just give some background here. I am fairly unique among commentators on this stuff because I am still a card-carrying free trader. And it's trader with a D, not a T, right? I'm not saying I'm a traitor, a free trader, meaning I don't think tariffs help Americans. Tariffs are taxes. However, I am not reflexively anti-MAGA. And I also understand there are nuances involved and that there are plenty of economically literate people advising Trump or just in general in support of looking again at these trade deals and, hey, what's going on with the U.S. economy and manufacturing and that sort of thing, who are interested in reforms that could involve tariffs. Okay. And I am sympathetic to that. And I don't just reject it out of hand and say, oh, these people don't know Econ 101, because that's kind of the divide you often see on social media, is that you got your economists who are free traders and think that, oh yeah, Trump and everybody involved in this is a complete buffoon. And then you have other people who say, oh yeah, all these ivory tower academic economists who don't understand what's happening on the ground to people who, the actual workers. Okay. And so, like I say, I'm trying to thread the needle here and acknowledge the legitimate points when they make them from the people who are saying something screwy with the status quo, but also to not all of a sudden end up saying that, oh yeah, if the U.S. government imposes taxes on imports, that's the way to bring prosperity to America. Like that, I still don't think that's true. Okay, so in that context, then I thought it'd be interesting to go through a couple clips here from the Lighthizer appearance on Tucker's show, because it'll showcase both elements here. That what I'm going to do is play two clips for you folks and then just go through and explain what he's talking about and make sure you understand the problem. And then you can see why, yes, this sort of casual dismissal of these concerns by the libertarian free trade crowd is just, oh, you guys don't understand anything. A trade deficit is a meaningless statistic. And hey, if foreigners want to invest in U.S. assets, that's because we're so awesome, which is the party line you'll get a lot of times on these matters. And so I want to show that, no, I think Lighthizer, a lot of the things he's pointing to are legitimate issues. But again, I'm going to disagree with him on what he's talking with Tucker about in terms of like what's driving all this. Okay. So to that end, let me first play, I think probably just in the interest of brevity and also just to get it all out and to make sure I don't miss things and anticipate and so forth. Let me just go ahead and play 2 clips for you folks, and then I will comment on them.
Thank you for coming on to explain this. I mean, my one frustration, I believe in what the White House is doing. I don't think enough Americans understand it. So I don't think there's anyone better at explaining it than you. I mean, you are the trade representative. What about our current system needs to be changed? Why is it important to do this, to institute tariffs, to rethink trade?
So that's the fundamental question, Tucker, and thank you for having me on. It's a pleasure to be here. Been a fan for a long time. So I think you have to start with the proposition, has the system failed? And to me, it's an emphatic yes. Now, I think of it in sort of 2 ways. One, if you think of the way trade is supposed to work, you're supposed to export in order to import that. And then you get the benefit of trade. You get you do what you do best, I do what I do best, or I do what you do less best.
Right.
You export, we import, and we get the benefit. We both have higher standards of living. That's not really it's evolved to. It's evolved to now where you have a few countries, the United States being the biggest, that have an open capital system and an open trading system, and other countries have an industrial policy that is designed not to increase the standard of living of their citizens, but to gain wealth. So what they're trying to do is get wealth in order to get assets in the United States, in order to get technology, in order to get all these kind of things that make you wealthy. So I think of the kind of failure points as being, one, because this system doesn't work, we have this giant transfer of wealth from the United States overseas, and that is in the form of trade deficits. And the way the system is supposed to work, no one should have large trade deficits for long periods of time. Things can happen. You can do it. You could have trade deficits with one country, surplus with another. But the notion of a country having hundreds of billions of dollars of trade deficits every year is not how it's supposed to work. We now are to the point where our trade deficits, they calculate them at about $700 or $800 billion. If you did it the way you or I would do in a sensible way, you'd probably be at $1 trillion or $1.25 trillion. So that's a transfer of wealth from Americans overseas in return for current consumption. And it has nothing to do with economics. It's entirely the result of industrial policy of other people and our being defenseless. There's a data point called the international investment position of a country. And that is how much, for us, all Americans own throughout the entire world versus how much everyone else owns here. That number is a negative $23.5 trillion. And if you said, what was it 20 years ago? It was probably a negative $3 trillion. So we have transferred about $20 trillion worth of our national wealth, and I would say the future income of that wealth, overseas in return for current consumption.
Can you explain?
Okay, so originally I was going to deal with those clips separately, like just play one and then comment on it for a bit and then play the other one. But because they're so similar, I thought, why don't I just go ahead and play them back to back, and I'll just address everything now in response. So first of all, let me just make sure you understand where he's coming from, that the U.S. trade deficit, and this ties back into what I was saying before about how sometimes the free traders are just completely dismissive of this stuff and they're acting like there's no big deal. And this recently happened. I covered it on a different podcast where on social media, somebody was talking about like a pro-Trump person who thought, hey, we got to do something about the rest of these countries around the world are ripping us off, or some of the major powers around the world are ripping us off, and we got to do something about the trade deficit. And so some guy who was steeped in libertarian economics came back and was like, oh, trade deficit's just a sign of our economic strength. It's just showing because we're rich enough that we can buy stuff from other people, even if they don't buy the same amount of stuff from us. So that's a sign of how strong we are economically. That's a good thing that we can afford to run trade deficits. And hey, I'm going to go run a trade deficit with Safeway right now. And it's just kind of indicating that, come on, this is silly stuff here. So the problem, that's fine insofar as it goes. But the problem with just saying that is it might lead the listener to think that the U.S. has trade deficits with some countries, but trade surpluses with other countries, and it kind of all balances out. And that's not the case. The U.S. does, or at least the last I checked, have trade surpluses with a few trading partners, but the surpluses are relatively small, and they're dwarfed by the combined trade deficits that the U.S. has with some other countries. Right, such that, in general, the U.S. vis-a-vis the rest of the world has been running a trade deficit for decades at this point. All right, so here, I'll just go ahead and flash up something to show you what I mean here. Okay, and so that buttresses Lighthizer's point that, hey, the theory of international trade and how things are supposed to work with comparative or specialization in your comparative advantage, and then each country trades, is that, the idea is, just like, I'm elaborating here, but he's not wrong. I'm spelling out the logic of what he was getting at. So he's saying, I'm not against trade. He was the trade representative, so presumably he's not against trade. But his point was, the way, in terms of the economics textbook and whatever, and the rationale given to why trade makes our people richer, is that other countries are better at making some things than we are. And so we specialize in the things where we're really good, and the other countries specialize in the things where they're really good, and we make more of the things that we're good at that our people are going to use, and the vice versa for the other countries, and then we trade the surplus with each other. The surplus, output relative to our domestic consumption for those items. And statistically in a given year, maybe you have your country has a trade surplus, but then it's going to be balanced by a trade deficit later. Just like you could say an individual household, you don't grow all your own food and make your own car and sew your own clothes and perform your own medical operations on yourself. What do? You specialize in the thing that you're really good at. That's what your quote job is. And you produce way more of that thing, that good or service, whatever it is that you're really talented at, than you're going to use personally. Like if you're really good at growing tomatoes, you specialize in that and you grow a lot more tomatoes than your family's going to eat. And then what do? You take the excess and you go to the market and you sell them, and then you use the money to go buy things that your family's not so good at making. Or if you're really good at being an accountant, you do a lot more tax returns than just for your own household. And then you earn money from that, and then you go and you buy tomatoes from the guy who's really good at growing tomatoes, right? So that's the point. And yes, at any given time period, maybe your spending exceeds your income, but that's fine, because then at a different time period, your income can exceed your spending. And so long as it's generally balanced, you're fine. Okay, and then you can get even more sophisticated with saving for retirement, whatever. But the nation as a whole isn't saving for retirement, right? Because it's not like we have our prime earning years for a couple decades and then, we're going to slowly die. Well, we hope not. So anyway, that's the kind of point he's making. And so his argument is sort of like classical economics, Adam Smith, David Ricardo literature in the case for countries allowing for the relatively free movement of goods across borders. He's saying that should lead to roughly balanced trade among the different trading partners. And that, yes, everybody benefits from that. And he's saying, but what is perverse and what's happened in our actual world is that amidst all of these free trade agreements and other things, the U.S. government has foolishly signed under both types of administrations. I didn't play it in the clip here, but in the discussion, he and Tucker talk about that. They say like the Clinton administration started something and then the George W. Bush administration continued it and so on. So they're saying this isn't a partisan thing, that they blame both parties for it, that the U.S., this hasn't been balanced trade. The U.S. has just been running chronic trade deficits. All right. So that, and again, as that chart that I showed you, that's certainly true. Okay. And then along with that, let me just spell out what he was getting at with the net international investment position. So everything he said was fine, but just to make sure you understand the point. So we can ask at any given time, we can say, hey, the American citizens, they own assets, and some of those assets are located abroad, right? So you as an American, you could own U.S. real estate, you could own U.S. stocks, equities, U.S. bonds, whether from U.S. corporations or the U.S. government or what have you. But you could also own real estate or shares of corporate stock or bonds issued in foreign jurisdictions. Maybe you own Australian real estate, or maybe you own bonds issued by the Japanese government. or maybe you own some stocks on the German stock exchange. And so they have statistics and they can add all that up and say, Americans collectively, what is the total US dollar amount of foreign assets that they own at a given point in time? And then you can also do the mirror image of that and say, looking at foreigners living outside the United States, what are the total amount of assets they own based in the US? So if you're some guy who lives in Germany and you own a share of a REIT based on, in US real estate, or if you own a share of the S&P 500, or if you own, or maybe you're like, you have a retirement plan and the company managing on your behalf owns some US treasuries, right? So even though you're a German citizen in this scenario, you own, perhaps indirectly, US based assets, right? And so you can do that calculation and say, people outside the US, what is the total dollar amount of assets they own that are based in the US? And so then the US net international investment position is the first number minus the second number. It's saying how much more do Americans own of non-US assets compared to how much do non-Americans own of US assets. And so if the number is negative, that means foreigners own more US assets than Americans own foreign assets. And again, notice some of those assets could be debt obligations, right? So if somebody in the United States borrows money from somebody in Germany, if it was a big enough contract or whatever, and it made it into the statistics, if you were just a tourist abroad and borrowed some euros from some guy to take the subway, that probably wouldn't show up in the statistics. But you get the point that conceptually, if an American borrows money from a German, though it's not that they wouldn't necessarily need to net out those things, but you could capture it either by saying, yes, the net ownership of US assets vis-a-vis Germans, or you could do it the other way around and say, Germany now owns another asset, namely a debt obligation from somebody in the United States. Okay, so anyways, as long as you're consistent with the accounting, it's fine. Okay? And so, as Lighthizer was saying, right now, he said the figures were like negative 23 trillion. Here, I'll show you this chart. At least the numbers that are shown up here on Fred, the St. Louis Federal Reserve site, it is the 2024 number is negative 26 trillion. Okay, and then as this chart also shows, is you might just say, well, has it always been a really big number, or is it just kind of growing? And you can see that, no, it collapsed rapidly. That if you go back to the 1980s, it was slightly positive, and it was basically hovering around zero all the way up through the late 90s. And then it was only in the late 90s that it really started falling off a cliff, such that, by now it's at, with my figures, negative 26 trillion. Okay. So and the last thing I'll mention too is notice that he was couching this as a transfer of wealth, right? That he was saying basically the US is giving up on net more ownership claims on US based assets than Americans are gaining of foreign assets. And what do we have to show for it? He was saying they're basically providing a flow of consumption. And that dovetails with the trade statistics, right? Because a trade deficit, what does it mean? It means if we're buying more imports than we're selling of exports, right? So we're spending more getting goodies from abroad coming into our country than foreigners are spending on us making goodies and sending it to them. And so that, those two statistics sort of reinforce each other, that it's in any event. Okay. And just to make sure you're getting the point. So the idea is if you borrowed money from the bank to go buy a factory because you were going to, start making stuff, or if you were a company and you issued bonds to raise funds to then go build a factory so you could increase your output next year and sell more product, that's qualitatively different than if you're a household and you charge a flight on your credit card and then go to a hotel resort somewhere and put it all on your credit card. It's just so you can have a fun vacation. So both scenarios involve running up gross debt, but in the first scenario, it's productive debt, that you're doing it in order to increase your future income. Whereas in the second scenario, where it's just funding a vacation, you're increasing your debt in order just to have present consumption. So that's what Lighthizer is saying here, is that what the US has done is basically given claims. His number's 23-ish trillion, my number's 26 trillion-ish over the last few decades to the rest of the world in exchange for what? That we had a higher standard of living the past few decades than we otherwise would have had. They were sending us cars and TVs and textiles and things that we could get on better terms than we could have made with our own resources and labor. All right. So let me first agree with his diagnosis that that's not a good sign. Okay. In a separate podcast, I quoted that in the Old Testament, at one point, the Lord is speaking to the children of Israel, and he's saying, if you follow my commands, and he's telling them all the good things that will happen. And one of them is, I'm paraphrasing, that you will be a lender to many nations and a borrower from none. You will rule over them and they won't rule over you. Okay. And so I'm saying you get the common sense point there. And the reason I'm stressing is in case you might say, like, yeah, Bob, we get it. It's because there are so many libertarian-minded economists or, people who've just read a lot in the literature and chime in on these things, even if they're not professionally economists on social media, that say anybody who's worried about the trade deficit is a complete idiot and you're failing Econ 101 and don't you know that this is all voluntary? And I'm saying, yes, prima facie, that is alarming, the sort of statistics that Lighthizer was relaying to Tucker and that I just showed for you visually here in this episode so far, that's alarming, and it won't do just to say, hey, this is fine. It's just a sign of how great the U.S. is. So to understand where that mentality is coming from, and I, in the mid-2000s, I was susceptible to this myself. So that's why I can speak with authority, because I used to think like this too. So I'm not trying to throw people on the bus or say that they're bad people or something. I understand where you could get this notion from. In terms of the accounting, yes, if your country were just this economic powerhouse and it was growing like gangbusters, and let's say your stock market was growing at like 15% annually, and it was sustainable, it wasn't like a bubble, but it was just like, no, because the companies are just making all these productivity improvements and everything's great, and you just have really low taxes and very sensible regulations, no crazy stuff going on. And it's just, what would be the quote right outcome for that? What's the sensible is that investment from around the world should flow into that area, right? All sorts of productive activities should get relocated there. Every business would want to be headquartered and have its operations in this region. And so how would that show up? Is, a lot of natural resources and semi-finished goods and things would flow in to this place to get completed there, and then so forth, right? So that would show up. And also too, like the companies located in that really booming economy, they might want to bring in outside capital in order to expand their operations, right? Like in other words, if they just reinvested their earnings, they could grow at a certain clip. But if it was just so great, I was like, oh man, we want to take what you're doing now and just quintuple it as fast as possible because this is so great. What you guys are doing here, this operation is the best on planet Earth. We want this to grow as fast as possible. Well, just reinvesting earnings isn't going to grow fast enough. So they got to issue more either debt or equity, right? Just to bring in outside funding. And the point is, however much wealth the people have who live in this region, you can still make your productive enterprises grow faster if you bring in outside investment, whether it's in the form of debt or equity. And so I'm saying, yes, and it's also sustainable, right? If by stipulation, the stock market's growing 15% a year, it's fine if foreigners on net keep acquiring larger dollar amounts of your stock market. That's totally sustainable, right? If your stock market is growing, like this year, it goes up by, I'm making numbers up, obviously, $5 trillion in terms of the market cap. And then next year it's going to go up by 6 trillion and then 7 trillion and 8 trillion like that. And then this year, foreigners on net acquire $1 trillion worth of your stocks over and above what you acquire of foreigner stocks. It's not like, oh no, they're going to eventually own our whole stock market. No, because your people, their ownership of the stock market is growing by more than foreigners. And that's consistent with the foreigners constantly measured in dollar terms, gaining more and more ownership in your country's stock market. That's totally sustainable. That can go on forever. It's fine. Okay. But again, what's not fine is if you're in a bubble and your stock market's rising and foreigners are getting a bunch of liens on your stuff and then stuff crashes and now your people's incomes collapse. Oops. And you still owe trillions and trillions of dollars in fixed income obligations to foreigners. And now you need to borrow money from them in order just to make ends meet, right? Or to sustain your standard of living because you can't bear to live within your means. Okay, so you see the contrast. So my point is, in terms of just the accounting, the fact that foreigners want to acquire more U.S. assets than vice versa, that by itself doesn't tell us that America's in trouble. Because again, if America's just the best place on earth to invest in, because it's got a strong rule of law and deep and liquid capital markets, and for all the reasons, if you're an investor anywhere on earth, to say what sort of things interest you, and if you say, oh, across the board, I want to invest in U.S.-based assets, well then what's going to happen? The U.S. is going to attract more investment than vice versa. And again, so that's fine. But the point is, the accounting doesn't show that it has to be fine. It's just saying it could be fine and sustainable. The accounting is also consistent with a scenario in which the reason your country's net international investment position keeps deteriorating is that you're sinking deeper into debt and you're living beyond your means. And yet the foreigners are extending your credit, or where analogy you want to use, the house keeps giving you more chips, but at some point they're going to cut you off and say, okay, and then you're in trouble. So that's what I want to say is, I think Lighthizer, him pointing to some of these statistics and trends, I don't think he's being a chicken little alarmist. He's being quite sensible and wise. And in contrast to, there are plenty of trained economists in the libertarian tradition who are my colleagues, and I think that they're very smart but foolish with some of the stances they're taking on these things. Okay. But now, having said all that, let me say that I disagree with Lighthizer's diagnosis of, hey, what's causing this? So you saw him allude a little bit in the clip I played for you, or the clips, that it's industrial policy, right? And so and then later, I didn't play it for you, but he was lamenting these free trade agreements and whatnot. And so to me, the issue is not, oh, what went wrong is a bunch of these foreign governments all of a sudden got shrewd and they started making strategic investments and adopting policies to expand their own key industries and manufacturing bases and things like that, and also setting up tariff barriers to keep out U.S. goods and whatnot to promote the industries that they thought were important for long-term geopolitical success, perhaps at the expense of the welfare of their own people, but nonetheless doing what they thought was in the long-run interest of the state. Whereas, we got Laurel and Hardy running our trade show over here, and we're just and let's have low taxes and let's not let the U.S. government pick winners and losers, and we'll just let markets. And I want to say, no, that's not the problem, right? Top-down central planning does not work. Socialism does not work. The reason the U.S. finds itself in a precarious position right now is not because our political officials foolishly refrained from taxing imports by having, quote, free trade and not having tariff barriers, or because they refrained from trying to pick winners and losers in terms of U.S. companies or even sectors, and to say, oh yeah, we got to put special provisions into legislation and regulations to make sure we have a strong manufacturing base and things like that. That's not the issue. It's government intervention coming from Washington, D.C. that has caused the problem, is my claim. Okay. And also a big component of all this stuff is just going to be chronic federal budget deficits. Okay. So let me just show you the charts to bolster those claims. So the first one here, I'm just going to show you again, the one I did before on the trade deficit. All right. And again, and this is a share of GDP. So you can say that it was largely balanced up until the early 70s. A notable exception was at the peak of World War II, where it gets like to negative 1% of GDP there. So that was in like 43, 44, eyeball in the chart. And then it shoots way positive right after the war in the late 40s. All right. And then it's roughly balanced. And then for some reason, it starts sinking in the early 70s. And then it just falls off a cliff, so to speak. Okay. So trying to make sense of this chart, I don't think the answer is, oh, the rest of the world was pretty laissez-faire, and then all of a sudden in the early 70s, a bunch of them got wise and started engaging in industrial policy, and they really ramped it up. That's not what's going on here. To me, what's clearly going on here is we're seeing what happened when the U.S. under Richard Nixon in 71 finally killed off the last remnants of the gold standard. So in case you don't know, before World War I, the entire world was on what we call the classical gold standard, right? All the currencies of the major powers were tied fairly rigidly to gold. The US dollar, the French franc, the German mark, Italian lira, the British pound, that anybody, not just like foreign central banks, but Joe Schmo could go up to Bureau of the US government and turn in dollars and get a certain amount of gold. And the exchange rate at that point was roughly $20.67 would get you an ounce of gold. And likewise, in Great Britain, it was 4.25 British pounds would get you an ounce of gold. And anybody could do that, just merchants could. And so what would happen is, so the US dollar and the British pound could still float against each other in the foreign exchange markets. There weren't price controls in the sense that if you tried to pay more or less for one currency with the other, the authorities were going to come after you. But there was like an anchor point because it worked out to about $4.86 US dollars per British pound if you do the arithmetic. Because what would happen is if the US government, for example, printed too many dollars, so that would cause the US dollar to fall against the British pound. So let's say the US dollar, like it rose to, you had to spend $5 to get a British pound. Well, then there would be an arbitrage opportunity, right? And I won't walk through the math of it, but you could take, you could take dollars, get gold with it, ship the gold across the ocean, and then get British pounds with it. And then you could end up with more dollars than you started out with, is how that operation would work. All right. So if you start out with a certain amount of US dollars, then you could exchange them at the rate of $20.67 to get, an ounce of gold, ship the ounce of gold across the ocean, give it to the Bank of England. They would give you 4.25 British pounds. Then the foreign exchange markets, you'd be able to get more than $20.67 for that. Okay, I guess I just did walk through the example, but that's the idea. And so if you think about it, what's the problem? What's the issue? So that shows if the US government had printed too many dollars, or rather, if they printed more dollars than the British authorities printed of pounds, so that the dollar started slipping against the pound, that would set up an arbitrage opportunity by which people would turn in dollars for gold in the United States, ship it across the ocean, and deposit gold into Bank of England's coffers. And so the country that inflated under the classical gold standard, and it wasn't just the US versus Great Britain. It was with France and, so they had all these bilateral exchange rates between any two countries. And the idea was if any one country started inflating more than its peers, the exchange rate of its currency would fall against its peers. And then there'd be an arbitrage incentive for people to ship gold out of the vaults of the country that was inflating its currency too rapidly. And so there was a quick check, right? And the idea was your gold reserves are falling, so you better stop inflating the currency and let your gold reserves, get built back up. Okay, so that was the check that the international classical gold standard put on all the powers. And that's what kept inflation under wraps up until World War I. Well, then World War I breaks out and all the major belligerents except the United States just completely go off the gold standard. Because how can we be expected to kill millions of people if we can't spend a bunch of money? What's a guy to do? So that's what happened. And anyway, skipping ahead in the story, after World War II, we had the Bretton Woods framework where it was basically the US dollar was still pegged to gold, now at the rate of $35 an ounce. So they had devalued the dollar significantly. That happened early on in FDR's first term. And the rest of the world was encouraged not to hold gold, but to hold US dollar denominated assets. So it was called a gold, like you call it, a gold reserve standard. Some people might call it like a dollar exchange standard or a gold exchange standard. Okay. And so the idea was that the rest of the world, instead of them holding stockpiles of gold, they would hold like US treasuries. But that was supposed to be as good as gold because, if we want, at any given time, we have the contractual right to just go turn in our dollars to the Federal Reserve and they owe us gold upon demand. So under the Bretton Woods framework, just to be clear, Joe Schmo could no longer turn in dollars for gold. That FDR, one of the first things he did in office was to suspend that. And in fact, made Americans turn in their gold under threat of a 10-year prison sentence or a huge fine. Okay, so incidentally, when people say, oh yeah, the U.S. went off gold, no, it's the FDR administration basically pointed guns at people and said, turn over your gold or you're going to get in trouble. All right. So I'm saying that system, the Bretton Woods framework by which foreign governments had the right to turn in dollars for gold, but nobody else did, that still kept a check on U.S. monetary inflation. Because the U.S. knew if we print too many dollars, foreigners are going to start stockpiling them, and at some point they might start wanting to redeem them. And in fact, the French did that under Charles de Gaulle, and the U.S. didn't like that, right? So the French said, hey, you're saying we can turn in our dollars for gold, so we'd like to do that, please. So that started putting strain on the Bretton Woods system. They were doing all sorts of makeshift things in the late 60s, and then finally in 71, in the Nixon administration, they just threw in the towel and just said, yeah, this isn't going to work. We have to either stop printing money or abandon the Bretton Woods peg. And Nixon decided, well, we're not going to stop printing money. We got all kinds of stuff we got to pay for. And so they closed the gold window. And from that point forward, we were on a truly fiat international monetary system where there was no tie to anything, any kind of commodity. Okay. So I'm saying that happened in 71. So you look at that chart, we'll flash it up again, and you can see, to me, it's pretty obvious what's the structural change in the global economy such that the U.S. was running, roughly balanced trade up until the early 70s. And then all of a sudden, I would say that was the taking the dollar off gold. And so in terms of the accounting, just to think it through, really one way of understanding it is that the world went from being on a gold standard, however diluted it was and tepid in the post-World War II era under Bretton Woods, it went from having a gold as being the global reserve asset to then the US dollar being the global reserve currency from 71 forward. Okay. And so under Bretton Woods, if the US printed too many dollars and foreigners started accumulating that, they might eventually say, we don't want to keep accumulating more dollars. We would rather have the gold. That's safer. So here's the dollars, give us the gold. Whereas if the reserve currency is itself the US dollar, the fiat thing itself, and that's where the buck stops, no pun intended, well then foreign central banks now, if they want to do, quote, the smart thing and just accumulate reserves for a rainy day, they can just stockpile treasuries, right? And so that's part, so it's almost like the US government from 71 forward now, or the US economy can export dollars. Like that's one of our exports. It'd be like under the classical gold standard, if there was some country, some little country somewhere that just had a bunch of gold mines. And in terms of the trade statistics, they just made a bunch of gold and shipped it out on net every year, depending on how you did the statistics. That might look like a huge trade deficit, right? Like the rest of the world's sending them cars and TVs and barrels of crude oil and stuff like that and sweaters. And these people just keep sending out gold coins or gold bars or whatever. And you say, geez, you guys just keep spending all this money buying all these imports and you're not making anything. No, you're not exporting any kind of produced goods. You got no manufacturing. You're just spending all this money. Like if gold is the money on planet Earth at that point, right? But you could also see how, well, no, that's totally sustainable that they make the gold in this country. So what to us looks like massive trade deficits, if you're not counting the gold itself as the export, to them could just be like, no, we do have balanced trade. We're exporting 16,000 pounds worth of gold and we're importing 16,000 gold pounds worth of merchandise every year. That's totally, what's the balanced trade? What are you talking about? So if now the planet Earth is not using gold as the money, but they're using US dollars, well then you can say, no, we don't have a trade deficit. What are you talking about? We exported $3 trillion worth of US currency and we imported $3 trillion US dollars worth of cars and textiles and TVs. What are you talking about? Okay. And notice too, if the rest of the world were happy just accumulating all those dollar balances and they never would be tempted to cash them in, then it would be fine. That would be sustainable. Okay. So that's, to me, to understand what happened to the U.S. trade balance and why did it get so bad. I mean, yeah, maybe stories about NAFTA or whatever can add some details, but to me, the big thing is going off the gold standard. And that's not, China didn't make us do that. That's not anybody else's fault but our own government's fault. And why did they do that? Is because they when push came to shove, they said, no, we want to keep printing money to fund our war expenditures and the so-called war on poverty and all that stuff. They could have just cut spending. The U.S. was on gold up to that point, except for, brief times during wars. And the U.S. economy was great. Yeah, on a hard gold commodity standard, the U.S. economy grew the most that ever had grown. Incidentally, too, that's partly when people like Lighthizer, I don't have a clip for you here, but with Tucker, and you see this elsewhere, different people in the Trump administration or Trump himself in some of his speeches talking about how awesome the U.S. did in the 1800s with just using tariffs as the primary way to raise revenue. Well, there's two things going on there. It's also that expenditures were very low, right? Because tariffs can't bring in that much revenue. There's just not that much of a base to tax. And if you jacked up the tariff rate too much, international trade would just get turned off, right? You would just make everything domestically. So yes, in the period when the U.S. government primarily relied on tariffs for revenue, the only reason that was feasible was the U.S. government didn't spend much. So as a libertarian economist myself, it's not surprising to say, oh yeah, in the period where the U.S. government didn't spend much, the economy was awesome. Well, yeah, that's not surprising. But also another major difference was back then the U.S. dollar was tied rigidly to gold. And that's also something I favor compared to the status quo we have now of the U.S. dollar being fiat currency. So my point is, yeah, the U.S. economy was a lot stronger in terms of its growth rate and things like that in the late 1800s compared to now, but I wouldn't say that's because tariffs per se are so awesome. Okay. The other thing I want to point out is, let me show you the U.S. government's debt. Okay. And so this is showing it as a share or percentage of GDP. Okay. And so you can see right now it is just a little bit shy of the all-time peak in World War II. And by the way, to come back, I forgot to mention on the other chart with the trade deficit stuff, the reason there was a relative peak in the trade deficit in the war years is, well, this is going to tie into what I'm talking about here. It's because the U.S. government was running a huge budget deficit at that point. Okay, and so here too, I'm going to say that there is a connection between U.S. government deficits and trade deficits. Right? They're not literally identical, like they're conceptually distinct. And you can imagine scenarios where the U.S. government has a huge budget deficit, but the country as a whole still has a trade surplus. So like it's not mathematically impossible, but in general, a U.S. government budget deficit would tend to go hand in hand with a U.S. country trade deficit. All right. And I'll elaborate on that a little bit, but I'm just seeing the World War II here reminded me of that. Okay. So you see right now we're flirting with all-time highs in the government debt, and the projections show it just runs away. Okay. And it's not because they're predicting all sorts of economic crises and alien invasions that are going to require massive government borrowing to build weapons to fend off the Martians. No, it's baked into the cake at this point that we have had relatively low interest rates when the debt mushroomed after first the financial crisis and then coronavirus panic. And so they stacking up the government debt, you can see it went from like 60 or 70% of GDP to now basically 100% just since the financial crisis hit at the tail end of the George W. Bush administration. But again, because there were financial crises, interest rates were very low, particularly interest rates on U.S. government debt, which is considered to be like the safest asset. And so just like if you're running up massive credit card debt, but you keep getting offers in the mail to roll it over at 0% APR for 6 months or 12 months with some new card, and you just keep moving your balances around, it doesn't really pinch. You don't fully realize just how much you've overspent when interest rates are relatively low. But then once those introductory 0% APR offers expire and it starts rolling over into 6.99% and 15.99%, it just keeps going up and up, then all of a sudden you're in big trouble. Okay, so that's one thing going on with these projections is to say, well, why is it that the debt all of a sudden just keeps rising, even though they're not building in projections of more global panics or massive world wars? There's that. And then also it's the aging of the population. Okay, so specifically Social Security and Medicare are vastly underfunded right now. You may have heard people talk about unfunded liabilities. That's what they mean. That right now, if you go look at the Social Security trustees report, it's underwater. It depends what time horizon you look at and the assumptions you make, but it's underwater by $30 trillion, something like that over a 75-year horizon. And likewise, Medicare is many trillions of dollars underwater, having to do with the aging of the population. Okay, so right now, those degrees of insolvency do not show up in the official statistics of Treasury debt. Just because the U.S. government right now has told Social Security participants, oh yeah, here's what the retirement schedules, the payment schedules look like when you retire. It's not like those people are holding Treasury bonds that pay off in 67 years or something. That's not the nature of that, quote, government obligation. It's just a vague, this is what the numbers are right now for current retirees. And so if it's like that when you retire, this is what you can expect to get in benefit checks. Okay, but over time, as those people actually do retire and then have to start getting checks from the government, the point is those unfunded liabilities that are sort of vague and just because of the nature of the expectations raised by the Social Security program and Medicare, those get transformed into explicit government debt when the government has to borrow money in order to pay the current Social Security recipients. That's the idea. And so that's why over time you see the official federal debt held by the public as a share of GDP just going up and up and up with no end in sight, is because of a combination, again, of rising interest rates and then those unfunded liabilities getting transformed into actual explicit Treasury debt. Okay, so what's my point in going through all this? Let me give you one last factoid, is that besides just looking at a share of GDP, what's the actual debt figure in dollar terms? In 2000, I think the first quarter is where I got this number from, the total federal debt was about $5.8 trillion. At the end of 2024, it had risen to $36 trillion. Okay, so over the period when Lighthizer is saying, oh yeah, the Americans' net international investment position has deteriorated by like $23 trillion, the US government's overall debt increased by about $30 trillion. All right, so I'm going to say that those aren't completely unrelated things. All right, so in general, just to now circle back and make the point that I alluded to earlier, a large US government budget deficit would tend to cause a trade deficit. And so the mechanism, there's two ways of seeing it. One, I'll do like a mechanical way. The US government wants to borrow more money, so they issue more bonds. So how do they raise the funds to do that? That has to induce people to lend more to the government than people wanted to before the bond issuance. So that means yields on US government debt have to be higher than they otherwise would have been, right? US government wants to borrow more, they have to increase the yield they're paying to induce people to lend them more money, okay? And so if foreigners now around the world want to expand their holdings of US government debt, how do they do that? If you're some guy in Germany and you have euros and you want to borrow more from the US government, you want to buy more US government bonds, well, you need to get dollars. So you take the euros and you buy dollars, and then you use the dollars to buy the government, to lend to the government, US government, right? So the people using euros to try to get US dollars on the foreign exchange market makes the dollar strengthen against the euro. So other things equal now, Americans see euro-priced goods as being cheaper. So it's now easier to import from Europe. And then vice versa, Europeans now see U.S. exports as being more expensive because the dollar has strengthened against the euro. So instead of exporting as much U.S. wheat, now you might not, because for a given dollar price of a bushel of wheat, now it's more expensive to you as someone using a euro. All right, so that's one way to see it mechanically about how rising U.S. government deficits can hurt U.S. exports and promote U.S. imports, which makes the trade deficit, quote, worse. A different way to see it is just in terms of the macro accounting, that if foreigners are going to acquire more U.S. debt, they got to send us something in exchange for it. And since the U.S. government is not interested in getting real estate in Australia or getting equity in the Tokyo stock market, but they want goods and services, that's why they're running the deficit, whether it's to build tanks and such during World War II, or now to fund benefit checks to Social Security recipients who then go spend it on food and rent and stuff like that. That's why it's going to show up in the trade statistics, the trade deficit. that the rest of the world is going to finance its acquisition of more U.S. government debt securities by sending us present consumption goods. Okay? So I'm just showing you kind of the accounting flip side to these issues, and that when Lighthizer is lamenting that, oh man, over the last few decades, Americans have accumulated, or foreigners have accumulated a lot more ownership of U.S. assets than vice versa. I'm going to say, well, yeah, probably a big reason for that is our federal government has added $30 trillion in debt over the last few decades. Some of it financed by Americans, but some of it also financed by foreigners. And by the way, it's, that's not the sole cause, but assets are fungible, right? So even if Americans absorbed a lot of that extra federal debt, that still crowds out their ability or willingness to absorb foreign assets. Like, so some U.S. pension fund, if it is sitting on $3 trillion of treasuries, well, if the U.S. government hadn't run those deficits in the first place, so those treasuries weren't available, maybe they would be holding foreign assets, the U.S. pension fund. So my point is, I'm not saying, oh yeah, the U.S. government borrowed the $23 trillion that Lighthizer is talking about from foreigners, and that there's a direct one-to-one correspondence between the U.S. government's outstanding debt and those statistics Lighthizer was pointing to. But I'm saying still, just the fact that there is an extra $30 trillion of U.S.-based debt that has to be owned by earthlings, surely that's a large part of the story. Okay, when basically Lighthizer is lamenting, why have Americans so much lived beyond their means over the last few decades? And I'm saying it's not because those wily Chinese are subsidizing their manufacturing operations. That's not what's going on. It's because the U.S. government has been running up massive budget deficits for decades. All right. So I think also Americans culturally are too much into consumerism and spending too much on houses and things like that. There's all that stuff too. But I'm just saying, in terms of structural policies that U.S. government officials could implement to start turning this ship around, instead of saying, hey, why don't we engage in top-down central planning, the way Chinese communists are, and that's the way we're going to stand up to them and their tricky ways, and say, no, why don't we first start by going back to a hard currency and not running enormous trillion-dollar-plus deficits year after year? That would go a long way towards fixing these problems. All right. Oh, let me show one last thing. One last chart I wanted to show is here you can see a breakdown of the international investment position, right? So this only goes back to 2014 or so. But the point is, you can see the gap is what's on the top there. The U.S. liabilities are in orange, the U.S. assets are in blue, and then you see the flip side on the bottom, and that's the net thing, and that's in gray. So what Lighthizer was talking about in the chart that I showed you guys that went back to the 80s, that's just the net position, right? As you can see, that's negative $26 trillion or something. But to decompose that, you can see that, what's going on is the U.S. owes more to foreigners than we have claims on their stuff. And you can see that what's been happening, it's not that U.S. assets have gone down. It's just that U.S. liabilities have gone up over time. Okay, so this, again, consistent with my claim. It's when you say, in terms of the accounting, why is it that the U.S. international net investment position has deteriorated by $23+ trillion over the last few decades? It's not just because Americans have sold off all of their holdings of foreign assets. It's that no, foreigners have gained more ownership of U.S. assets, in particular U.S. liabilities. And so again, this is consistent with my story that a major part of why this has happened is because the U.S. federal government has run up an enormous $30 trillion of debt just since 2000. Okay. So there are still lots of issues about trade policy and manufacturing jobs and things like that. We can defer to a future episode, but I hope I've convinced you that, yes, Lighthizer's not crazy for worrying about a lot of these things, but I can think of a lot more immediate, sensible policy changes that would do a lot to addressing these issues, rather than saying, why don't we start centrally planning our economy too? And I'm not saying that's what Lighthizer was literally advocating on Tucker's show. But again, he was attributing the loss of our economic strengths to the fact that these foreign governments were engaging in industrial policy and we were just kind of flat-footed and not responding in kind, or at least acknowledging that they were doing that. And I want to say, no, it's the Chinese didn't trick us into running up $30 trillion in government debt since 2000. That's on Americans. Okay, folks, thanks for your attention. See you next time.